CHPY's returns crushed it in 2025, and it wasn't even a whole year, nearly 50%, and the fund only existed for 9 months. The big question investors are wondering, will it continue into 2026? In this video, we're going to break down CHPY, the risk investors are exposed to, a closer look at its optimal strategy, an assessment of the fund's underlying valuation. A big thank you to our subscriber, Mr. Clean, for requesting this video. If you have a fund or financial product you'd like me to review, leave it in the comments down below. I've reviewed other covered call funds like SPYI, QQQI, and GPIX on this channel for other subscribers. Check those out too. CHPY has been alive for less than a year. Fund inception was April 2025. However, the performance in that time has been a market-crushing 49%. CHPY is concentrated on the semiconductor industry. The prospectus defines a semiconductor company as companies that are involved in the design, manufacture, or sale of semiconductors or semiconductor equipment. To me, it feels like CHPY is trying to ride the, quote, picks and shovels aspect of the artificial intelligence boom. Otherwise, I don't see the particular investment rationale for focusing on semiconductors specifically. On top of the sector focus, CHPY uses covered calls and call spreads. The prospectus describes the fund strategy as follows. Separately, the fund employs various option strategies focused on generating premiums. Generally speaking, the fund sells, writes, options on some or all of the underlying securities, receiving premiums from counterparties that pay for the right to buy or sell at a set price. These premiums are an important driver of the fund's distributions. On a weekly basis, the advisor uses one or more option strategies to seek to generate net premiums, i.e. option premiums received less option premiums paid. Receipt of an option premium does not always represent income, depending on the outcome of the overall options transaction. Further, the fund's overall objectives as stated in the prospectus are: the fund's primary objective is to seek current income. The fund's secondary objective is to seek capital appreciation in investments in a select portfolio of semiconductor companies. Investors need to appreciate the inherently contradictory nature of these objectives. If investors believe in and want exposure to the boom in artificial intelligence via the semiconductor industry, then adding a covered call strategy on top of the sector concentration has an offsetting effect. Covered calls cap the upside potential an investor can experience from equities gains. So if investors are expecting the covered call strategy to provide downside protection, they should be aware that in general, the downside protection provided by covered calls is pretty limited. Importantly, and as you'll see in a moment, that might end up being particularly true in a situation where an entire sector appears to have a high valuation. All that said, and as noted in the prospectus, the fund's primary objective is to seek current income. Let's look at where that income might be coming from. The fund shows a distribution rate of 45% as of January 6, 2026. The primary investment objective is current income, and presumably that's why investors are opting in to buy CHPY. I think for investors, it's reasonable to consider the source of income available to support such a high distribution rate. There are 3 sources of income for equity-focused funds: company dividends, capital gains, and option incomes, in this case with covered call strategies. If there are no meaningful cash or bond holdings, then interest income isn't a factor. The 3 sources I just mentioned, that's it. Let's talk about each one by one now. Dividends. This is the easy one because for this group of companies, the weighted average dividend yield is minimal, less than 1%. After dividends, CHPY would need to generate 44% in returns of income to avoid cutting distributions. Keep that in mind. Okay, so source number 2, option income. This one's a little tricky because recent data is not yet available until the latest financial statements for the fund are released. However, the July 2025 statements show that CHPY lost approximately $800,000 writing options on a net asset base of $29 million. CHPY's current asset base is approximately $190 million for reference. Now, remember, the fund inception was April 2025, so as of July, that's not a lot of operating history. But that said, the fund's distribution goal is weekly income, and the option strategy appears geared to match that. Anyway, the bottom line is that for the data that is available, which is limited, the option strategy was not profitable. Investors should look carefully at the most recent financial statements whenever they get released. Furthermore, the fund's prospectus states that, quote, the option strategy most frequently utilized by the fund is a covered call spread, which is a type of credit spread. The fund uses covered call spreads to earn premium by selling a call option while buying another at a higher strike, with both profit and losses capped. Call spreads reduce the amount of net premium income CHPY receives because it involves buying calls, which is a cost of premium. The benefit, of course, is that losses are capped, but if investors are expecting covered call writing to supply sufficient premium income to deliver a 44% annualized distribution, that seems even less likely with call spreads. On January 8th, I downloaded the fund holding data. The fund had a call spread on LRCX, which is Lam Research Corp. For this spread, they sold 696 calls of $175 strike. They received $28.52 and a half cents per share and bought 696 calls at a $180 strike for $23.27 and a half cents per share. Maturity for both contracts was January 9th. Remember, the fund looks for weekly income, so obviously this is a very short-term contracts. At the same time, the fund owns 77,099 shares of LRCX. The payoff of the trade looks something like this. On a net basis, CHPY collects $5.25 upfront, which is the difference between the short call premiums received and the long call premiums paid. If the stock ends below $175 per share, CHPY keeps the entire $5.25 in net premium. If it ends above $180, CHPY effectively nets 25 cents per share. For reference, LRCX was trading over $200 per share on January 9th. So investors might be thinking, great, free money, not so fast. You need to factor in trading costs and taxes. That 25 cents per share carries a cost to execute. This is just one example. However, you can see how in rising markets, a 25-cent spread before cost is unlikely to generate the kinds of distribution rates investors saw in 2025. I've looked at a lot of covered call funds at this point. The majority of them have unprofitable option writing strategies. Why? Because equity markets have significantly increased in 2025. Covered calls cap that increase, which means the fund either needs to close the trade at a loss or deliver the underlying asset at an effective loss. Frankly, I think it speaks to the covered call space itself. Selling calls is not a magic button for easy income. Investors need to be aware of this. And in rising markets, these covered call trades are likely to be losing money in my view. Let's be generous and say that writing covered calls has produced neutral results for CHPY. Not positive, not negative, but just a wash. I say generous because of the data we do have, it was money losing and markets have been rising. So that's why I have this view. So in terms of sources of income that were sufficient to support a 45% annual distribution rate, that really leaves capital gains, which is source number 3. In this department, the fund has delivered. Cumulative returns since inception are 49%. As discussed, I think it's basically all gains since dividends and option premiums aren't significant enough to make up the majority of income sources. If we look at the one-year gains for current stocks in the portfolio, it's about 70% as a simple average or 85% using the current portfolio weights. 70% return in a single year. That's enormous. As a subsector, semiconductors have crushed it for 2025. The question for investors is, can this pace of gains continue? If the AI hype does not materialize as expected, then what? What happens to distributions? Okay, so as you can see from the table, the PE ratios for this group of stocks is already very high, at around 89 times earnings. If we were to remove the extreme outliers of Intel and Lattice Semiconductor, the average is still very high at about 46 times earnings. 46 times earnings is a lot. It suggests that investors are expecting a very high rate of earnings growth for these group of companies. To put this in perspective, the semiconductors sector's trailing PE ratios have been much lower, around 35 times based on the S&P Semiconductor Index. Forward PE ratios are even lower at 24 times. CHPY's current portfolio PE ratio is well above these figures. As well, the 10-year annual returns for the index are about 20%, which is well below 2025 returns for the portfolio. Does this mean that good times can't keep going for CHPY? Not necessarily, but investors should remember, prices have already increased. To continue to increase at a rate that allows distributions to stay at this current level, earnings would have to beat already high expectations baked in the stock price. Personally, I think that's investors are taking on a lot of risk with that sort of bet. And if the stocks don't beat expectations, or even if they just match expectations, I think CHPY will be hard pressed to maintain distributions at the current level, and they could even be cut. What could they be cut to? I have no idea. But remember, it's a sector that has a high valuation, high expectations, stock prices that have already run up, and a requirement to deliver income every single week. It just strikes me as a high risk proposition for investors to consider and to invest in. Doesn't mean they can't do it, but just remember, if it's going to be a portion of your portfolio, keep in mind the level of risk you're taking. Okay, so in conclusion, 2025 was an amazing year for CHPY and the semiconductor industry. I think it's important for investors who rely on current income from CHPY to realize that the majority of this income is likely coming from gains in the underlying stocks, and that those stocks have run up to very expensive valuations already. If earnings from the artificial intelligence trade do not materialize as expected, it feels like there could be a good chance these stocks could pull back to lower valuation levels and distributions get cut. Hi, I'm Charles. I don't like most investing and finance content online. It tends to try to sell you something. You don't need to buy anything from me. This content is for entertainment purposes. Seek professional advice for your situation. I want to make financial freedom accessible to the average person. Profit is desirable, ownership is freedom. Good luck and goodbye.